But despite all of this economic worry and the general government muppetry that's been happening over the last month, my stocks and shares have still managed to increase in value by nearly £2,000 this month. Hello and welcome back to another episode of my journey to FIRE, which stands for Financial Independence and Retire Early. One of my long-term goals is to earn enough passive income to fund a good lifestyle without the need for a 9-to-5 job. In this video series, I give an update every month on how I'm investing my money to generate passive income, including the income that I earn from stocks and shares, rental income and savings interest. This is the 10th episode of this series and I've realised I've never explained why I'm doing this. In a nutshell, there's loads of information and videos online about how to become wealthy through investing. So this video series is about putting that advice into practice and documenting the progress every month. Now bear in mind, I don't listen to everything I hear online, as there's a lot of finance experts that try to sell you the get-rich-quick dream. And whilst I think it's important to be open-minded about new ideas, I don't think you should be so open-minded that your brain falls out. My strategy is to take the long-term approach to investing, and so far it's worked pretty well for me. So first up, let's take a look at the stocks and shares I received this month in my Stocks and Shares ISA portfolio. It was a quiet month for dividends for me this month, with the only dividend I received coming from the Global X Super Dividend, which paid me £42. This is a new investment for me, and the ETF invests in around the top 100 dividend producing stocks on the market, providing that those stocks have good fundamental financials. Not only that, but the ETF pays out their dividends monthly, so you're guaranteed to get a nice little top up every month. This investment is considered a little bit more high risk, but considering my total investment portfolio is kind of medium to low risk, I've deemed it a risk worth taking. Plus, how can you say no to an ETF paying an 11.19% dividend yield? So with the addition of this month's dividend, this brings my total dividends since January to around £3,000. I also find it useful to track my passive income progress by comparing my dividends to previous years. As you can see from the graph, my dividends have increased by an average of 31% per year when looking at dividends from January to November. Next up, let's take a look at the stocks and shares. As with the dividends, there's not been a lot of activity in my stocks and shares ISA portfolio this month either. And whilst that might sound a little bit boring, when you're taking a long-term approach to investing, 99% of what you need to do is nothing. My normal strategy would be to drip feed in money every month and use my entire £20,000 ISA allowance on my stocks and shares portfolio. However, I've decided to put the remainder of my ISA allowance for this financial year, which was £8,000, into a cash ISA instead. This is because I want to stop renting out my flat in London and look to buy a house elsewhere. And this decision to put a pause on investing in the stock market is purely to mitigate risk. The last thing I'd want to happen is to put all of my savings in the stock market, and then when it comes to putting down a deposit for a house, the market crashes and I can no longer afford to buy. So from now until when I look to buy the house, all of my spare income and savings will go into a high interest, risk-free savings account instead. But going back to stocks and shares, recent events have made me think that maybe I should be doing a bit of reshuffling in my stocks and shares portfolio. For example, the tax announcements in the new autumn budget that was released last month seem to be a death sentence for certain industries and companies in the UK. The government have even said themselves that because of these changes, they expect the economy to grow between 1 to 2% per year over the next 3 years. So with that forecast, why would I choose to invest in the UK economy? Wouldn't it make more financial sense to take my money out of UK investments and put it in something with better predicted returns like the S&P 500? But that being said, who knows what's going to happen to US share prices when Trump gets back into office?
I would imagine it can only get worse.
They're bringing crime, they're rapists.
But we have some bad hombres here, and we're going to get them out.
And some, I assume, are good people.
But we're going to build a wall. Who's going to pay for the wall?
And I think you can see I'm having a good time. I really am.
His intentions are to spur growth in the US economy by creating more jobs and also by reducing taxes for American people and businesses. However, he intends to do this by introducing tariffs on foreign imports, which historically have caused a retaliatory price hike from other countries, causing both the US and their trading partners to be financially worse off. And whilst tax cuts sound great, taxes are how the government get their money, so they're either going to have to reduce spending or go into more debt, neither of which are good for the economy. So as you can probably understand, I'm scratching my head a little bit now about where I should be investing my money. Personally, I think I'm just going to trust the process and keep drip feeding my money into these ETFs as I have been. But despite all of this economic worry and the general government muppetry that's been happening over the last month, my stocks and shares have still managed to increase in value by nearly £2,000 this month. There was a bit of a drop off at the start of the month, bringing them down to 105k, but within 3 to 4 weeks, they'd reached an all-time high of £109,000, averaging out at around £107,000 for this month. Every weekend when the markets are closed, I personally like to write down the value of my stocks and shares ISA portfolio, and that helps me generate an average monthly value. In this graph, the blue line represents the average monthly value of my stocks and shares ISA, and the red line and the numbers in the table show how much the value of the portfolio has actually changed after you exclude the money I've invested into the account. This is an increase of just over £10,000 since January, or around 13%. Not bad. My portfolio consists of the following companies and funds, and you can also see in this pie chart the relative weightings of each holding in my portfolio based on their value. That's it for stocks and shares. Let's move on to property. In terms of property, I own a 2-bedroom, 1-bathroom flat in the East Midlands of the UK. I used to live there myself for 3 years, but when I changed job and moved to London, I decided to keep it and rent it out. After property management costs, this month I received £1,144. This brings my total rental income for this calendar year to around £10,900. Wherever you look online, you'll hear people say that in order to become wealthy, you need to make your money work for you, i.e. buying assets that generate you money. And that property is a great way to do that. And you'll hear statistics thrown around like 90% of millionaires became millionaires by investing in property, i.e. buying property and renting it out. And while this may still be the case in some places, personally, I believe that in the UK, that ship has sailed. A few decades ago, a house in the UK would have cost you around 4 times your annual salary. This made it easy for people to buy a property, rent it out, and then use the rental income to cover the mortgage, whilst also making a decent profit themselves. And this just meant that people could repeat the process of buying a house, renting it out again and again, almost guaranteeing themselves that they were going to make money every single time. And before you know it, you'd be making so much passive income from rent that you could just buy houses outright without the need to put down a mortgage. I actually knew a couple of guys when I was living in the East Midlands who, between them, bought over 150 properties in the UK between the 90s and 2020s. And they were raking it in. However, today, buying a property in the UK is closer to 9 times your annual salary. This means that it's far less likely that the money you get from renting out a property will even cover your mortgage. Also, to buy a rental property, otherwise known as a buy-to-let property, you typically have to put down a much bigger deposit, as well as paying a much higher interest rate on the mortgage, making it extremely difficult to make any money. So in my opinion, I think the idea of the average person today building their wealth through property is dead. I think today's generation are much better off investing in the stock market, or at a bare minimum, trying to grow their money in savings accounts. And that brings me nicely onto my next source of passive income. Last up, we have interest. For my savings accounts, up until this month, I used Zopa, which is an online app-based bank. There's nothing wrong with Zopa, but they did recently reduce their interest payouts to 4.3%, so I decided to have another look online about what other banks were offering. To do this, I always use the Money Saving Expert website, which will keep you up to date with all of the best offerings on savings accounts and ISAs. I saw that Monument Bank were offering a good rate of 4.76% on a 7-day notice period account, so I decided to open up an account with them. By the way, if you've got any cash laying around and it's just sat in your bank, not generating you any money, do yourself a favor and look into some of these savings accounts. Otherwise, you're just turning down risk-free money. So this month, my savings accounts have generated me £93, which brings my total interest for the year to around £1,900. So to summarise, so far this year I've received £2,962 in dividends, £10,892 in rental income, and £1,879 in money from interest in savings accounts. This comes to a grand total of £15,735 in passive income since January. But if you also account for the £10,056 in capital gains from my stocks and shares ISA, this comes to a grand total of £25,791 in totally passive income since January this year. The next episode will be my end of year review, where we'll look back on all of the passive income that's been generated this year, compare that to previous years, and forecast what it's going to look like in the next 12 months. So if you found this video interesting or insightful, or want to join me on my journey to FIRE, then click subscribe, and why not give it a little like too for good measure. Thanks for watching, I'll see you in the next one.